Trump is the big news really of the year. All the news is focused on him, and I think there are three really important sectors.
Time Man of the Year.
Exactly.
Person of the Year.
Person of the Year. And I think there are three really important areas that you need to focus on when it comes to Trump. And so we've got the commercial policy, the trade policy, which is basically tariffs, his sanctions and geopolitical policy, so international relations, and then his domestic internal economic policy.
Hello and welcome to episode 17 of Oil Insights. I'm your host, Harry Tchilinguirian, Group Head of Research at Onyx Capital Group, and I'm joined today by Onyx Research Associates Martha Dowding, Vincent Wu, Will Cunliffe, and Edward Hayden-Briffett. We almost have a full deck of analysts here today. Now, before we start the show, please like and subscribe to the podcast. I invite you to also visit Onyx's LinkedIn and YouTube channels for more interesting and exciting content. This is the last Oil Insights podcast for this year. And as the year draws to a close, front-month Brent oil futures are trading in the low 70s, at least at the time of the recording of this podcast. In this episode, we would like to take the opportunity to discuss a couple of this year's oil market drivers and whether these will continue to shape oil price developments in 2025. We'll also aim, basically, to focus on the items that we believe will continue to strongly influence the direction of oil prices and not be entirely exhaustive. Now, we'll also examine what new developments the oil markets will have to contend with in 2025 and what our global oil balance says about the state of affairs for supply and demand next year. Now, when it comes to 2024, the ups and downs of geopolitical risk have certainly buffeted oil prices. In fundamentals, there's been wide divergence in agency forecasts around the global oil demand growth figure for 2024, a divergence in particular between the IEA and the OPEC Secretariat, which I might add has yet to be fully resolved. Finally, the OPEC Plus group is delaying a return of voluntary cut barrels to the latter part of 2025. Money managers' market positioning on Brent has been very hesitant in the second half of 2024, and their appetite to deploy risk and add length given the macroeconomic circumstances has been circumspect, to say the least. Now, speaking of macroeconomic circumstances, in 2024, we saw central banks initiate monetary policy easing, with the Fed and the ECB beginning to cut rates. However, they were not alone in cutting rates. China's central bank has also stood out in its efforts to support the economy and counteract deflationary pressures. However, so far, China has enjoyed limited success and more stimulus, both fiscal and monetary, is necessary in 2025. Now, 2024 was an important election year with Donald Trump elected as the 47th President of the United States. That election brought forth an agenda regarding trade, diplomatic relations, and domestic policies that will considerably be impacting the global economic outlook, geopolitical relations, and of course, oil in 2025. Now, Mr. Trump, who has been nominated Times Magazine Person of the Year, will play an important role, not just for oil in 2025, but as saying, for global markets in general. Now, when it comes to the global oil balance of 2025, we stand apart from the generally constructive chorus of banks and consultants following the OPEC decision to delay the return of their barrels next year. For some pundits, OPEC Plus basically waved a magic wand and removed the projected surplus in 2025. We disagree with that. The barrel arithmetic of the global oil balance is invariably fraught with uncertainty. We know that. And nowhere is that uncertainty more critical in inferring implied global stock changes than the measurement of OPEC crude supply itself. But more on that later in the podcast. So let's begin with positioning and risk takers. So I'm going to be turning to Vincent Wu on this one. And Vincent, could you walk us through the positioning this year of money managers on Brent futures? I mean, certainly, the year started relatively well. People were willing to engage. And then things kind of turned around. And more recently, it's been a little bit hesitant.
Certainly much more hesitant in recent times. So looking at speculative money manager positioning in Brent futures, we can say it's been a year of two halves. So the first half was a lot more bullish on the back of the increased geopolitical risk premium. But in the second half, it became a lot more bearish as the market anticipated OPEC supply hikes as well, output hikes, as well as worsening outlook for demand. Notably, during the trough especially in August and September, positioning was extremely bearish. So bearish that it was lower than, the net positioning was lower than COVID levels back in March 2020, indicating that money managers were very hesitant to get long, and there were a lot of bearish positions in Brent, in a sense, because of the fact that short positions had become overcrowded. This also in turn had limited the downside for Brent crude prices, which meant that there wasn't as much risk capacity to be deployed to push prices below 70.
So we got to a point in terms of bearishness that we were unwilling to go further.
Precisely.
Okay.
So further on, so let's elaborate a bit more. So despite the geopolitical risk that's ever present in the Middle East, it was quite hard for bulls to get excited about oil, because whilst there were a few scares in the year, such as the Red Sea attacks or Iran striking Israel and vice versa, the actual risk to the oil production, infrastructure and transportation was never really in danger. Also, the main contention was the global economic uncertainty, especially with weakness in China and Europe souring demand expectations, especially when there were consistently bearish economic data readings.
So would you say that the macro had maybe a more prevalent role when it came to positioning than the general supply and demand fundamentals themselves? Was that like sort of the overarching theme?
There was, I believe, two parts. So there was the overarching weak macroeconomic narrative, but in terms of supply and demand, I would also say that because the macro narrative led to expectations of weak oil demand growth, this was also linked to concerns around OPEC strategy, because of the low demand growth, they were forced to continue their supply cuts into next year. And we have seen a lot of non-OPEC rival producers contributing to a lot of that oil supply growth, such as the US, Brazil, Canada, Guyana, and the likes, which have created a market surplus. So from a more general risk appetite perspective, as my colleague will discuss at further length later, was that the pace of central bank monetary easing policy, particularly by the Fed. So early this year, the hopes were that the rate cuts would be more aggressive, but now recently this did not materialize, because more economists, policymakers are questioning that the Fed might pause some rate cuts next year, taking a less dovish and more hawkish approach on fears that Trump's policies may stoke higher inflation. So hence the prospect of a higher dollar would create headwinds for oil prices.
So again, still a lot of macro going on there in the background. And when it comes to long-short positioning, where do we stand? Because I think typically when you look back at this year, whenever we traded above $80, $85, the ratio of long to shorts for money managers was in the area of at least 3 and above, right? 3.5 in terms of the ratio. Are we anywhere near those levels?
No. So currently the ratio is just below 3 to 1, around the 30th percentile for the last 10 years. So it's relatively skewed towards the bear side. The data over the course of the year shows that when Brent was above $80, the ratio was typically 4 to 1 or higher. So what this means is that money managers on the bullish side are pretty sidelined and are quite hesitant to deploy risk as a result of the factors that was mentioned earlier, especially in the macro.
So that's certainly interesting, because in effect, even though if we saw the net futures position of money managers creep a little bit higher in the fourth quarter, at the end of the day, we're looking at people who are reluctant right now to deploy risk. And the uncertainties that we're going to go over through a number of them over the course of this podcast are such that despite all the dry powder, which effectively could be unleashed and lead to a price spike, as some people expect, at the end of the day, we really are looking for some kind of strong catalyst, and to send prices higher and to have re-engagement and get those longs going again. I mean, short of a black swan event or a massive disruption in supply, we're not going to get that kind of positive surprise out of demand, right? So again, this category of market participants and the flow that they generate is probably going to still be sitting on the fence, for 2025. Would you agree with that?
I would. It is, like you said, absence of supply disruptions or black swan events. It's very difficult to be bullish about oil going into 2025. There's a lack of bullish factors going around right now.
So speaking of black swan events, that kind of takes us to geopolitics, because there's a lot of those in geopolitics, because the situation in the Middle East is extremely fluid. And so for that, we're going to have a look back and look forward at geopolitics. And so Martha, there were a lot of developments in the Middle East in particular that could have provided plenty of fodder for the bulls and for positioning to get super long again. But it seems that every single time that we had a spike in tensions, the market rapidly faded the price spike. And meanwhile, beyond the Middle East, war in Ukraine has continued. So can we expect more of the same next year when we look at the key geopolitical developments? I mean, can you give us your take on what's going on, what has happened and what's going on?
So looking at the geopolitical picture as a sum of its parts, we'll look first to the Middle East, where I think the running war between Israel and Hamas, and then additionally Israel and Hezbollah and Lebanon, it has been kind of escalating with the intensity of the Israeli kinetic action throughout the year. But there was very little impact on the oil prices, and if they have been, they've been kind of short-lived. And as you said, they've been absorbed really well. And I think they've been realistic about the barrels at risk of the actual oil supply in these countries. We'll keep this in mind, but throughout the year, it's hard to see this kind of escalation stopping in terms of the conflict, and we expect Israel to continue the operations in Gaza and we know in Lebanon and Yemen and everywhere around there until such time as the government's targets are met and there's the hostage deal, for example, or for when a more sturdy ceasefire has come into effect.
Okay. So further in the Middle East, of course, there's the elephant in the room is Iran, right? Yeah. And so take us through a little bit what has happened and maybe what your thinking is about Iran next year in terms of geopolitical, developments.
Yeah, I think that with the previously mentioned conflicts, the kind of hot button would always be, oh, what about Iran? What are they going to do? But that kind of came to a head when there was that standoff between Israel and Iran earlier this year. So Iran shot into Israel directly, which was a massive escalation. And this was in relation to the Hezbollah head killing. Iran launched these missiles at Israel, and Israel's response was deemed as proportionate. And I think there was lots of use of words like theatrical and kind of getting a good, both of them when having the return fire have been, issuing warnings, not hitting, anything that would send the market into a tizzy, which I think didn't invite that tit for tat escalation that we've seen before. And I think this kind of playing down de-escalation after escalation has been kind of the theme with these players this year for sure. But the spiraling scenario for next year that could be that could obviously change everything would be the involvement of the US. And I think that drawing the US into a conflict would be a complete, change of the hand of cards that we've got. And I think that with the US, with the Donald Trump presidency, I think there will be more of a conciliatory stance next year to kind of avoid that max pressure on Iran and to minimize any more sanctions that he could be putting on, because I think that's definitely been the rhetoric in the candidates he's put forward as well, to minimize risk on like the nuclear and oil sites. And
right. So I guess the Middle East, in effect, with every development we had, is a market essentially came to the quick conclusion that oil supply or transport of oil would not be disrupted. I was saying earlier, meanwhile, the conflict in Ukraine has kept on going. And what have we seen there? What can we expect?
So Russia, the long and short of it is Russia's gained more territory and they've had the addition of some North Korean troops, apparently. But Ukraine has, on the other hand, received more and more advanced weaponry, more sophisticated weaponry from the US especially, but also in Europe and France and the UK too. So this can strike further into Russia. As the years progress, they've basically been able to move further into the country. And the thing with this is when they've been given permission to use, when they've been given the weapons, they have been basically told not to strike the oil infrastructure of the country, which has kind of protected, the oil price premium a little bit. But there's a bit of a stalemate here towards looking to the future into next year. I think it's going to be, again, really important, all eyes on Trump, to look for to broker an end of the war, to get a kind of deal here and a forced solution to Ukraine. And he couldn't have been more clear that his attitude towards Ukraine is going to be the polar opposite to Biden's. So whether that can be true, whether that is true is still to be seen. But if this effort is successful, then there should be a de-escalation here in Russia.
Yeah, that's certainly a very interesting point in terms of policy orientations between Trump and Biden. At the end of the day, we know that on the Republican side, money going to Ukraine is a contentious issue. And whether Donald Trump could, on a single phone call, resolve the war, well, that remains to be seen. The solution, as you highlighted, may be forced upon Ukraine. But in terms of overall geopolitical tensions and potential consequences in terms of how energy supplies out of Russia flow, currently being shunted essentially to China and India as far as the crude is concerned, products, various other markets and Western markets. But that will be interesting. But now, thinking about 2025, I mean, we had a new development in the Middle East, and that will need to be resolved, and that's essentially Syria.
Yeah, I think Syria, the geopolitical tensions that could arise from Syria will be the wild card for next year. This is kind of, this toppling of the Bashar al-Assad regime has kind of happened pretty quickly in the scale of things of the year. And so the toppling of the regime precipitated likely by Russian, Iranian and Hezbollah disengagement, not kind of keeping that propped up. But I think there's lots of different views on what the new Syria will look like under the new regime. I think listening to the actual government, they've been very clear they don't want any more wars. They're tired of wars. And they've specifically come out and said, we do not want any problems with Israel right now. But with that being said, Israel is not kind of taking any chances there. And they've been striking military assets. They've been moving further into Golan Heights. And there is that, no matter the rhetoric from the Syrian government, that is still progressing. So it will be interesting to see how, peace-loving the government will be. But there's lots of different interpretations of that. But again, looking at the barrels at risk, Syria is an oil-producing country, but only about 30,000 barrels a day, not a huge amount. So I think it will be focusing on the relationship with Israel, of the new government and all of the other kind of Middle Eastern countries, and whether friendly relationship, whether we could bring some cooling of tensions in the Middle East here. But definitely a wild card here.
Yeah, I think Syria is interesting because you're saying what shape will the new government take? The question is, will we have one government? Will we have a Syria divided in three parts, a Kurdish region, the new rulers of Damas, and of course we also have other groupings further in the south of the country. So what the new Syria will involve, I guess the important thing is, relations with Israel. At the end of the day, relations with Israel, considering that, prior to the falling of the Assad regime, Iran obviously had a big stake in Syria, and this is through Syria used to pass weapons and finance to its proxies in Lebanon. How will Iran let go or not of that situation remains to be seen. Russia had stakes in Syria, and we've seen a flurry of diplomatic activity, Western diplomatic activity to engage. So we'll see what the stance is relative to Israel, but it sort of kind of always comes back and revolves around the same things. Israel's relation relative to other Middle Eastern countries, and then obviously back to the elephant in the room that we're talking about earlier, Iran, and how that dynamic is going to evolve. So moving a little bit away from geopolitics, I'd like to turn to macroeconomics. So we're not going to be doing a macroeconomic forecast here, but what we're going to be focusing on, as I was saying earlier in the intro, is monetary easing. So this year has been the year of monetary easing. Both the Fed and the ECB have initiated a policy rate cut. And the question really is, how do we see the reaction function of each of these banks? What path they're going to take. Yesterday we had the FOMC meeting, so I'm going to be turning to Will to talk about the Fed in particular, in light of consequences that Vincent highlighted for the dollar. And then we're going to get talking around China and what the PBOC is doing. So, Will, starting with the Fed, I mean, well, what did yesterday's FOMC produce? Were there any surprises relative to expectations? So give us a lowdown.
Yeah, so it was an interesting one. Yesterday, the FOMC decided to cut the federal funds rate by 25 basis points to a target range of 4.25 to 4.5%, and this was pretty much fully priced by the market ahead of the meeting. But what was interesting was the hawkish rhetoric that emerged after that, and now it's not necessarily a given really that the Fed is going to move again in January. Jerome Powell has indicated that the Fed is not in a rush to keep cutting, given the latest labour market and inflation data. The former has undershot the Fed, whilst the latter has overshot their projections. So there may be a desire to slow the pace of cuts. And market-based inflation expectations have really shot up since September. So we've seen 5-year break-evens jump 50 bips in that time period. There is a possibility, therefore, for the Fed to skip January and perhaps even March and opt to move only in May, which is what the OIS is currently pricing.
And how did this reflect in their dot plot? Because everyone's always keeping an eye on how FOMC members are considering the future and the number of rate cuts. So markets are pricing in less. And is that a direct consequence of the new projections, or at least new estimates by Fed members of where policy rates should lie at the end of the year?
Exactly. So the Fed dot plot compared to what was priced in September's FOMC is expecting about half the cuts next year compared to September. So they've got a median rate of 3.9% at the end of next year and 3.6% at the end of 2026. So yeah, that in and of itself is far more hawkish than what we were expecting before.
So that's an implication of 2 more cuts, right, for next year, rather than maybe the 3 that people were originally expecting, right?
Exactly, yes. Well, they're expecting 100 bips next year. In September, that's what they're indicating.
So the shock here, the bullish shock is even, or I should say hawkish shock, is even more, right?
Yes,
yeah.
yes.
And I want to talk, how about the language? Because we're talking about pausing, and when it comes to expressions from Jerome Powell, do we even have a sense of what the timeline of a pause is?
Yeah, I mean, it's very hard to get any definitive information out of Powell's speeches. He likes to keep his options open. But last night's FOMC, he did come out and say that we can therefore be more cautious as we consider further adjustments to our policy rate. And this is probably coming in light of a healthy debate among committee members with regards to Trump policy. And, Trump has come out and indicated potentially 25% tariffs on Canada and Mexico, 10% on the EU, 60% on China, on top of what is already there. So this, taken with he's going to spend, is what's really driving this repricing of inflation expectations, and amongst the committee, how they assess upside risks to inflation in that setting.
So to be a little bit controversial around the Fed, and because obviously all of this really, what we're concerned about is yield differentials, right? If the ECB will be sequentially cutting, then we're going to have a divergence between US yields and European yields, and strengthen the dollar and the dollar index, which is heavily weighted euro, for example. But you said something very interesting in terms of, Jerome Powell sort of playing it, keeping his cards very close to his chest. I'd suspect that, the FOMC and whether it be in the press conference or the statement that we got afterwards, they cannot talk about how they incorporate potential inflationary consequences of a future Trump administration. So it's when people look at future policy, there is this consensus, of course, that it will be inflationary if implemented in the sort of implementation plan that has been discussed during the campaign, right? Yeah. So if we were to look at this a bit dynamically, in essence, the labor market is doing okay. Yeah. There is stickiness in prices to the downside. And we have the possibility for inflation expectations, which ultimately determine realized inflation, to become unanchored. Yeah. And so the Fed will, I imagine, have to play dynamically. Do you think we could end up in the sort of catch-22 situation where, I'm just throwing it out there, where the Fed may actually have to pause for most of next year if policy is implemented in the way we think it's going to be implemented?
Yeah, I mean, it's certainly a possibility. I mean, you know, the Fed likes to reiterate that it's a data-driven committee that make the decisions based on the data available at the time. Of course, they will be forward-looking. They'll be running the scenarios through all of their modelling infrastructure, and they'll be preparing potential responses to different policy. But yeah, you're completely right in that it would probably be an overstep for them to offer any sort of view on their expectations for Trump policy and whether that would be good or bad for the macroeconomic picture in the US. And because of that, therefore, it becomes challenging for them to communicate whether it will be inflationary, not only from that then becoming embedded in inflation expectations, but also because it contradicts their independence.
So while the Fed is just conducted a hawkish cut and is going to be pausing, if we go to the other side of the world now and start looking at China, obviously there's been a strong desire over in the second half of the year by the Chinese government to afford support to the economy, whether it's through fiscal channels or monetary channels. And the PBOC has already implemented monetary policy easing. And so could you take us through a little bit what they did this year, whether we think it's enough, or what can we expect them to do next year?
Yeah. So
how's that working out for them? That's basically the bottom line to my question.
Yeah. So the PBOC and the CCP have kind of thrown everything at the Chinese economy that they could so far. They've been cutting the reserve requirement ratios, other key lending rates that affect consumer borrowing and mortgage rates, and other kind of ad hoc policy initiatives and swap facilities, to boost liquidity in the banking sector. But China's a little bit idiosyncratic in some ways, and it does face considerable headwinds to policy. Historically, savings rates in China are far higher. You know, they're around 50%, even when the economy is performing. In the US, that statistic's closer to 5%. And you know, any economics textbook will tell you the fiscal multiplier is an inverse function of the savings rate. So clearly the efficacy of stimulus in China will be diminished relative to economies like the US. They have to do more to be able to get that response in the Chinese consumer.
So just to follow on that point, the fiscal multiplier not doing as well, but I think from a monetary policy perspective and basically bringing the cost of borrowing down, I think you and I had this discussion many times. To get monetary expansion, it's not enough to cut the cost of money. You need demand for credit, right? You need the consumer, private companies to borrow. And so basically, after having made these cuts, what have we seen in terms of the latest monetary data, borrowing data? What, have they achieved their goals, or are we lagging behind?
Yeah, so whilst the PBOC has reduced their medium-term lending rates and reserve requirement ratios to historic lows, we've really not seen a positive response in credit conditions in China. When you look at the latest data, loans increased in November, as did total social financing, but the progress on loans came in well below expectations. Lenders issued about 580 billion yuan worth of new loans. That compares to 995 billion yuan that was expected by the market. Aggregate financing rose by around 2.3 trillion yuan, and that was well below the 2.7 trillion yuan expected. And then outstanding yuan loan growth as an aggregate has continued to slow to 7.7% in November, and that's the slowest pace since at least 1998 when records began. And then loans to the real economy, which exclude those to financial institutions, fell by the lowest since 2009 in November. So household appetite for credit is really, really poor in China, even despite all of the liquidity boosting that the PBOC has done and the policy rate cutting.
So I guess China's grand desires to swap consumption or exports for consumption when it comes to sustaining its GDP growth are obviously going to be suffering from the reluctance, let's say, or hesitancy in terms of borrowing, whether that's the natural propensity to save of a consumer or just simply the outlook that precludes that because wealth of the Chinese consumer being tied up in real estate markets, those obviously having seen prices come down by a significant amount, well, they're probably not ready to just go out there to buy those big ticket items just yet, right?
Completely. I mean, until the negative equity that Chinese households find themselves in today is reversed and consumer optimism in China recovers, there's going to be very little the PBOC or the CCP can do really to drive that.
So for next year, I mean, what's objective number one for the PBOC? What cuts can we expect if the response is yet lagging in terms of basically monetary expansion, whether it be M2, credit, loans?
Yeah, so they're most likely going to continue to do all that they can to try to support the Chinese economy and achieve that 5% growth target. So we expect the PBOC to continue cutting the reserve requirement ratio, and the consumer goods trading program will likely be expanded as well. In our view, the soundings from the China Central Economic Work Conference were roughly in line with what they were saying at the Politburo's meeting, in that the Chinese economy will require a generally looser monetary stance and fiscal stance. The RRR likely will be cut.
So cutting reserve requirement ratios, more on rates. But as we know, when it comes to the Economic Working Committee, Politburo orientations, there's a question of implementation in China. So I guess that there are a lot of people that are banking, especially when bringing it back in the context of oil demand and recovery in the Chinese economy to stimulate demand. And some people have forecasts for Chinese demand or oil demand that are higher than ours based on the fact that somehow there's going to be a sudden transference, from fiscal stimuli or monetary stimuli into growth that would then allow to prop up Chinese oil demand. Personally, I'm not convinced because between the sort of lag that we have between issuing the guidance, implementing, and then having those effects actually materialize in the economy. So I guess what? China is not out of the woods just yet, right?
Definitely not. And that lag is, in the US, for example, considered to be around 6 months for a monetary policy stimulus.
So
in China, it's going to be even longer than that because of that savings ratio.
So I suppose even if they complement it with further fiscal stimuli, then maybe the second half of the year is a year where we're going to see that impact, and then obviously onwards onto oil demand, yeah?
Yeah.
Okay. Well, thanks, Will. I guess now we're going to be turning to something a little bit different because we talked a lot about things that happened in 2024, and we're going to be talking about things that are going to be happening in 2025. And with that, we're going to be turning to Ed to talk about the future Trump presidency. So Ed, in episode 14 of Oil Insights, we delved into the implications of what a new Trump administration would be. But I guess it would be important to actually review these with you in terms of what they could mean for oil markets next year. So what are the key things that we're focusing on, and in terms of what we could expect from this new administration as having an impact on oil markets?
Well, Trump is the big news really of the year. All the news is focused on him, and I think there are three really important sectors.
Time Man of the Year,
exactly.
Person of the Year,
and I think there are three really important areas that you need to focus on when it comes to Trump. And so we've got the commercial policy, the trade policy, which is basically tariffs, his sanctions and geopolitical policy, so international relations, and then his domestic internal economic policy. So to start with the commercial policy, tariff is the most beautiful word. We know that. It's touted all through. Exactly. So yeah, tariffs really are the stick half of the carrot and the stick equation, and he's been threatening to clobber, particularly China. Really, China's the number one target with any imports. He's going to clobber them with massive tariffs in addition to the existing restrictions. So for China, as Will said, they've been trying to stimulate domestic growth, domestic demand growth, but they're still very export focused. So, and the US is the largest single destination for Chinese exports. So if Trump imposes these really strict tariffs, that will really harm Chinese exports and therefore demand for oil products, particularly diesel and also feedstocks for petchem production. So that's one aspect that really would be a negative of the tariffs, plus obviously the GDP impact that would kind of cause a slowdown in economic growth, which is kind of part of the broader macro picture. But it's not only China. It's also the nearest neighbors he's got is Canada and Mexico. And for Canada, the most important thing really is the most important commodity or export they have is crude oil. They send almost all of their exports of crude oil over the southern border into the US. And it's a heavy crude, generally the Canadian crude. So the US refineries are set up to process that. And if you add import quotas, or even the export taxes that Canada's threatened to retaliate with, that will just massively increase the costs of Canadian crude coming into the US. It may force US refiners to re-optimize, which would be really expensive for them as well. And so the overall cost of any crude and crude products would skyrocket. So that really wouldn't help Trump with his $3 per gallon gasoline dream that he's been touting for years.
It'll be interesting to see if, at least if with the Canadians, his relations with Prime Minister Justin Trudeau improve a little bit. Of course, he's been offering Canada to become the 51st state of the United States to help ease tensions. I'm not sure that went down too well. But
if it's the 51st state, they will have no concern with import tariffs. So that will solve the problem entirely.
So Justin Trudeau will be the governor of the great state of Canada. But I mean, joking aside, I guess it's quite interesting because there is a dual nature of tariffs, because we're talking about affecting demand for oil through obviously reducing or negatively affecting economic growth in China. But we're also talking about, I mean, Mexico as well supplies crude to the US at the Gulf Coast refiners, equally a heavy crude. And it would be odd if there was a blanket 25% tariff that included energy, in my view. So,
that's kind of the consensus really, because from a Deutsche Bank survey, for instance, only 18% of the respondents thought that Trump would be as aggressive with his tariffs, or even more aggressive than he had suggested in the campaign. So the consensus expectation is that it won't be as excessive as perhaps he was showing off about.
Okay, so let's turn to geopolitics and Trump. I mean, Martha touched a little bit in terms of what could happen in Ukraine, but the key, I guess, one of the key focuses, again, coming back to the famous elephant, which is Iran, but we're talking about sanction policy, and what can we expect,
Yeah, well, if Trump does want to return to his maximum pressure campaign, which is perfectly possible, and I think it's, in a way, it would be politically a good time to do so. Iran looks quite isolated now compared to even just 3 months ago. Hamas and Hezbollah have really taken a pounding from Israel. Assad has fallen. So in the Middle Eastern region, Iran is quite lonely now. It doesn't have that many allies. Of course, they have made this diplomatic push to be more open and develop relations with, for instance, the Saudis and the other regional powers. But I think that Iran does look quite isolated in that sense. And also, its main buyer of crude, China, has shown in the last month that it is prepared to go without Iranian crude. It's prepared to go to West African grades, to the spot market to get its supply. So Iran can't just bank on China, who would ignore the US sanctions. So I think if Trump does want to go down that path, he could well do it with some good success. And that could cause, like last time it was something like 1 million barrel per day drop in Iranian exports.
Yeah. So it's an interesting one because there's a lot of consensus around this. And as you said, now maybe Iran's diminished position could lead it to be, as Martha was saying, a little bit more conciliatory. And that offers up an interesting proposition, because if you're taxing Canada and Mexico and driving the cost of your crude up, do you really want to knock out 1 million barrels a day out of the market, tighten the crude market, support, if not help, raise the price of crude, which ultimately, feeds back into the price of gasoline at home? I'm a little bit dubious, and this is not obviously this is not a Main Street view, that he's going to go max pressure. I think he'll do some pressure to get what he wants out of Iran, maybe easier access to nuclear sites. Something has to be resolved there. But there is a case to be made that the effectiveness of maximum pressure sanctions, given the nature of how Iranian oil is taken to Malaysia and then from Malaysia to China, China could do without, maybe in the context of trade negotiations. But at the end of the day, do you want to knock out 1 million barrels a day out of the market when you're promising cheap gasoline at home?
Of course not. Politically, it wouldn't make sense to say, I'm going to bring down the cost of your gasoline, and he's kept on going about the inflation that Biden oversaw during his presidency, so he's not going to want to see that return.
Okay, so I mean, we had obviously tariffs, sanctions policy. We talked a little bit earlier in terms of new relations with Russia that may lead to something, and then finally there's the domestic front, right? The domestic front quite important, right?
Yeah, I mean, drill, baby, drill. That's one of the catchphrases from this campaign, from this year, really, because Trump obviously wants to produce this massive amount more crude to bring down prices of the consumer. That'd be very popular, obviously, because everyone likes paying less for their gasoline when they're filling up their tank. And Besant, his secretary, he said he wants 3 million barrels per day more, and
of oil equivalent.
Sorry, specifically, yes. So it sounds nice on paper, but realistically, it's difficult to you can't just magic it up. For one thing, it takes time to actually set up the additional production capacity, and you've got to convince the producers to actually do it. You can't force them to. You have to incentivize them through reduced regulations, faster permits perhaps, less environmental regulation or licensing needed. But you can't force these big producers, these Exxons, the Chevrons, etc., to produce more. And Exxon next year is cutting its capex budget. So
that's already that's a key point. It's like people tend to, or I say people, maybe President-elect Trump seems to forget that it's not a state-driven decision, right? You can make the circumstances extremely accommodating for supply growth, whether it's going to gush under a drill, baby, drill scenario, now that the industry has moved on to greater capital discipline. So obviously they set themselves production targets, spend accordingly. They don't, like the infancy of shale, price went up, people borrowed a lot, spend a lot of money, produce a lot. Now the whole, I guess, decision-making process has changed. And I mean, arguably, you could have access to federal land. Offshore drilling could be allowed, et cetera, et cetera.
Exactly. You can make it much more attractive, but you can't
force it.
Mandate a certain production level, at least not in the US. That's not how the market works.
Okay, cool. Thank you very much, Ed. And I guess we're coming towards the end of the show, but we're going to talk a little bit about the global oil balance and how we are looking at it at Onyx. So the global oil balance next year looks, well, pretty ugly. Our research subscribers can find the details of our balance on the Onyx Hub. But I want to begin with demand. At Onyx, we adopt a top-down approach for estimating total oil demand based on GDP and other activity proxy forecasts, to which we then add our own discretionary judgment in the case of external factors which could skew the traditional relations between activity and oil demand, like, for example, strong EV penetration in China that is government-driven. So our first look at world oil demand in 2025 sees growth of about 1.3 million barrels per day compared to just under 900 KBD in 2024. Slight contraction in OECD countries that is centered around its European and Asian members, partially offset by growth at the US. Like in 2024, growth will be driven in 25 by non-OECD countries. Total increment will be 1.3 million barrels per day. And once again, Asia is where the growth is at, with China and other Asian economies delivering a rise of nearly 800 kbd of oil demand in 2025. On the supply side, when we're looking at non-OPEC countries, the growth in total liquid supply will come to about 1.5 million barrels a day, so exceeding our expectation for world oil demand growth. In the meantime, OPEC is at a standstill, at least for now, delaying the reinstatement of voluntary cuts for the end of 2025. Now, the combination of non-OPEC oil supply and global demand means that if OPEC production remained flat, there would invariably be implied global oil stock builds. The question really is how much? So to answer that question, we must first answer by how much more OPEC will produce over the call on OPEC crude, which is the amount of crude necessary to balance the market without a stock or price change. Now, second, and this is quite critical, the answer will also depend on what your current assessment of crude oil supply is out of OPEC. The IEA for 2025 sees an average call on OPEC crude at about 26.3 million barrels per day. So if OPEC held production of crude constant at 27.1 million barrels a day, or the average of Q3 as the IEA sees it, well, you'll end up with at least an 800 kbd stock build on average for the year. Now, turning to OPEC Secretariat's secondary sources, they place Q3 production at 26.5 million barrels a day. So if you were to believe that number and use it with the IEA call on crude, although it's not apples and apples, but you'd get an implied build of only 200 kbd. Now, push that argument a little bit further and go to alternative sources like petrologistics, and things start looking extremely different. For example, OPEC secondary sources place the UAE and Iraq's crude production at almost 3 million barrels per day and 4.2 million barrels a day, respectively. That's in Q3 2024. Now, take petrologistics' view on crude oil supply for these two countries, and you get close to 3.7 million barrels per day for the UAE and some 4.7 million barrels per day for Iraq in Q3. Now, together, these two countries, under Petrolog's assessment, mean 1 million barrels a day more than what OPEC Secretariat's carefully curated secondary sources are suggesting. So imagine adding that difference to the IEA's implied global balance in 2025. So we're looking at a stock build which technically could be a lot higher. While estimates of global oil demand and non-OPEC supply for 2025 are not that far apart on an absolute basis, the assessment of OPEC crude production does make a difference, and we see that in the various numbers that are out there. Will we actually get a build of 1 million barrels a day? Well, probably not, because with data revisions, some of the missing barrels in the equation are probably going to come back into the mix. But the outlook next year suggests that OPEC Plus will find it challenging to bring back those voluntary supply cut barrels back into the market. Now, the one saving grace, I guess, for OPEC from this point of view, in terms of flat price, is that the implied buildup of inventories is likely to take place off a projected relatively low base of oil inventories at the end of 2024. Now, with that, we get to our famous crystal ball moment. And this is where we get to opine on where the oil price may be next year. So, after having said everything we said, and looking at what the price action has been over the course of December, we've been in the low 70s, and it seems that this 70 area represents a bit of a hard floor. So I'd like to get your guys' take on whether you think 70 is non-breachable, breachable, maybe a magnet where we say for a few more months. Do you want to kick us off? What do you think? Above, below 70, at 70?
I'm of the opinion that we'll remain in the low 70s for now, for the rest of December at least. But I think there's not much left. But
I'm checking out.
But then towards the end of
how about Q1, Q2?
Q1, Q2, I think before midpoint of Q1, I think we could dip into the 60s. At which point, I think if the technical positioning is moved because of that dip, then I think we'll be moving much more towards a longer term 60s market. So I'm thinking most of 2025 will be in the 60s.
Martha, bearish, bullish?
Yeah, I think I'm going to be a negative Nancy like usual, but I think it's pretty similar to what you were saying. I think that, as I've said before, getting into the 60s, and then you see the really good buying, people seeing good value there. But I think with the forecast we've presented, there's like the surplus expected. So I think it would depend on what kind of the rhetoric of demand is out of China, how well it's responding to the stimulus, if we are told that, and also the health of the dollar as well, because that's been just crazy this year. But I think it's important to look at positioning, how Vincent was mentioning earlier, that we had these instances of such strong pessimistic view from money managers in Brent, and I think now we're seeing a more balanced market. We have a bit more of an opportunity to sell off, because when the market was so bearish, it was almost too bearishly positioned to see a significant sell-off from funds. So I think that's kind of a better position, more balanced position to be entering the new year in.
Okay, interesting. So obviously there are cross currents in the price. The economic outlook predicating Chinese oil demand growth, risks of tariffs slowing that growth, dollar with Fed policy maybe being on hold for longer. Vincent, what do you make of everything we said today?
Yeah, on my side, I'm fairly neutral for a few reasons. At least in the next few months, I do expect flat price to stay above 70. The 70 dollar level has been an area of tremendous technical support, and of course lower flat price would incentivize buying from Chinese refiners and from the US to refill their SPR. Of course, the OPEC update has sort of tightened balances ever so slightly, and should the compensation cuts work out, then this would take out a lot of barrels from the market as it currently stands. So this is what I will be banking on, and of course we hope to see greater demand coming from elsewhere, including China. But absence of sustained demand rise or significant bullish catalyst, I struggle to see Brent going above 80, as all rallies earlier this year have been quickly faded and reversed downwards. So fairly neutral.
It's quite interesting. You seem to see, like, obviously the sort of opportunistic buying argument, and I mean, countries like China, whether or not they project to have oil product demand, which would then entice their refineries to buy more crude, you know, whether they project that or not, if the price is right, they will buy it. So of course there is that argument in terms of opportunistic buying. Should we move under $70, that could bring in a lot. On the other hand, of course, if we're arguing strong dollar and emerging market economies that obviously need to pay in dollars their oil, if their currency is devalued, it's a more costlier proposition as well. So there's a little bit of a mitigating factor. But I tend to agree that, okay, our balances don't look good, and we know all the caveats around balances, around missing barrels and over reporting of demand, statistical error, all that kind of stuff. But we have this surplus, and I suppose that it's building, arguably off a low base by the end of 2024. So maybe not enough to flip the market into a contango, but certainly enough to flatten the curve a little bit and weigh on prices. So I'd personally be disposed to think we could test below $70. Then after that, if that's a trigger for all the dry powder of managed money to come back in and buy it, or have refiners or even countries dedicate resources to buying cheaper oil, well, that could bring prices back up. But I'd be tempted by the argument to slip below 70. So I'm going to turn to Will now. So Will, you heard your colleagues, you heard me. We're a bit divided, but there seems to be a consensus where 70 is sort of a sweet spot around which there's a lot of uncertainty as to whether we dip below or hold just above in that, low 70 to 75 range. And what do you think for next year? Not for the end of the year, right?
Yes, yeah.
Because Ed was a little bit too prompt, right? So if we're thinking first half, let's say, or first quarter. Given everything we said, our balance, the uncertainties, Fed policy, all of that put together, if you were to come up with some kind of conclusion.
Yeah, so our balance is undeniably pretty bearish, and I think that fundamental picture has been pretty consistent in recent times as well. But flat price has been really well supported at 70. And we see, especially in the physical window in Dubai, as soon as flat price looks to be moving through the $70 handle, China will come in and buy a lot. And we've seen Totsa buying a lot of Dubai crude and a lot of North Sea
You're
crude.
using a bit of a Vincent's argumentation of opportunistic buying, where when the price is right, and especially for Chinese buyers, whether they come out themselves or use proxies in order to procure their crude. This is, well, it is definitely, I mean, this was a case back when we had extremely low prices following the great financial recession. China came up buying all sorts of commodities that were cheaply priced. Didn't mean that they necessarily use them then and there. The objective was longer term, but I suppose that's one leg of support to 70.
Exactly, but I think we will continue to test the $70 handle through Q1, and then potentially, if that support doesn't hold up and China decide they've bought enough oil and their inventories are too big, we could go through support, potentially triggering stop losses, and then seeing flat price descend further until again people decide it's time to buy back their short positions.
Okay, well, that brings us close to the end of the forecast. Well, actually, I'm not even close. We are at the end of the forecast. 2025 is going to be year of the snake, according to Chinese astrology. And so that's renewable. So like the snake, be quick thinking, elegant, and charming in 2025. So from all of us here at Onyx Capital, we wish you a very Merry Christmas and a great trading year in 2025. We'll see you next year. Of course, I'd be at a remit if I didn't say smash that like button. And today, for all those bass players out there, you could slap that like button. Thank you very much, and we'll see you next year.